long time Apple bear, I would say maybe it's another qualification. I think historically I've tried to help investors figure out how Apple product cycles would play year after year. And actually, if you look at where Apple and the iPhone is positioned today, they're actually very well positioned. They're entering into a 5G cycle. And what we've learned in what Apple reported in the last quarter is that their business, their consumers, iPhone buyers have been very, very strong. iPhone sales in the second calendar quarter were up 3% year on year, which is almost unbelievable. And the reason for that is that affluent consumers have been locked down, but have not lost that much purchasing power. They spent less money on travel, less money on restaurants, and they've actually spent more money on iPhone. And I think that's a setup as we enter the new product cycle. Apple is going to launch 4 5G phones by the end of the year. And now all what we hear from the supply chain of Apple is that the company is preparing for a record number of new phones to be produced and to be launched. So you could ask me why not having like a more positive view on the stock? Well, I think you've described relatively well where valuation stands today. I think all these stocks, for the moment, we have a neutral view on them. That's purely a valuation perspective.
All right, so the sell-off that we've seen since Tuesday, you think reflects more momentum unwinding or a better realization of some of the risks going into the 5G cycle, risks about service margins, risks about volume risk if they try to make it up with higher ASPs, and the kinds of things that we've been hearing from other downgrades lately?
It's a very good question. And I think in the sell-off you see today, very little is specific to Apple. I think the sell-off is broader in tech. Ciena, a couple of days ago, was a very significant catalyst. Ciena sells networking equipment, and they say they were seeing their order book drying up, and they guided the next quarter more than 20% below where expectations were. And Ciena was a wake-up call for tech, reminding that in this environment, a lot of projects, a lot of investments may not go through. And so all tech reacted to that. To be honest, I think for Apple, Apple is relatively remotely exposed to that risk because Apple is of course a consumer business and is like an affluent consumer business, which is an area where I don't think you have negative surprise. There is one negative surprise I expect in the 5G cycle. This is gross margin. Making a 5G phone is very expensive. You need to add between $50 and $100 of components and antennas and radio components and baseband in an iPhone to make it fully fledged 5G capable. And I don't think Apple will, push that extra cost to consumers. They will see more value in absorbing the vast majority of that cost to make sure that 5G ramps in their install base rapidly so that they can offer new services based on 5G.
Okay. So, Pierre, I admire your bold calls on Apple over the years when so few people were willing to say, sell here or buy there, and you have made calls on both sides of it. But I wonder, can you really rate Apple in this market where it's a blue chip? Some people argue it's a growth stock. Some people are probably using it in place of bonds because of the dividend. I mean, so many people feel like they have to own Apple. Is it as much about the fundamentals of the company anymore?
Yeah, I think thanks for pointing it out. It's very difficult. I think it's having a conviction on Apple that you can return on an actionable opportunity for my clients or institutional investors is very difficult. Apple is a blue chip. Owning it or not owning it is far less related to the detailed fundamentals and moving parts of how the business is doing. Having like a fundamental absolute perspective on the valuation of the company is also very difficult. So we've actually been fairly neutral on Apple for some time, and we're kind of waiting to see how, the way the street looks at the name evolves so that we can put fundamentals back into perspective again. But today, as you see, we're very positive on the 5G cycle, and we can't really feel comfortable recommending to buy the stock given valuation. So it's a very odd situation.
All right, Pierre, let's turn to Tesla now. It is having trouble again today, along with much of the rest of the market. Shares down more than 5.5%, 20% since Tuesday. What's your feeling about Tesla? Because I know you think that Elon Musk has some ambitious goals, for example, when it comes to a fleet of autonomous vehicles. And even though if he can't reach those goals, you think he's still going to do really well?
Yes. So if you look at Tesla today, things that are very tangible, things that I'm buying, things I believe in with a very high level of conviction, is they have like unique EV cars in terms of performance. They are building an iconic brand, and they are like an innovation machine on this electric vehicle technology. And in addition to that, they have like by far the best assisted driving technology in the market. So these are the things I love. And for these things, if I play them out over the next 5 years, I think Tesla is going to be, in 5 years from now, the size of BMW with twice better margins. And that is going to be worth by then, like, I think $2,500, maybe $3,000.
Wait, why is it worth that? Because, I mean, even if it is that, doesn't it have to be so much more, whether in terms of batteries or selling its core technology to other car companies, to justify the valuation where it is now? Exactly.
Then on top of that, you have the energy storage opportunities, the solar opportunity, the insurance opportunity that I think is potentially very tangible. And then you have also the opportunity for Tesla to really achieve something that is close to full self-driving. But all these things are like going to play out and start getting material and visible only in multiple years. So I am not keen to buy these things today. I think it's not a good use of capital. So if I had bought like Tesla last week at $2,000 on the other stock price, so for $400, $450 or even $500, I mean, that's still reasonable, but that means your money is going to do nothing for the next 5 years. In 5 years from now, we'll have a lot of visibility on what lies beyond Tesla in terms of all these other business opportunities. But today, think about each of these opportunities as being a high-quality unicorn startup. So FSD is a good unicorn. Insurance is a good unicorn. Tesla Power is a good unicorn. Let's say you value them $20 billion each, which is a lot of money for unicorns, okay? Even say $10 billion each would be very generous. That would represent a relatively small moving part compared to the market cap of Tesla today. So I think today I recommend my clients to buy Tesla on the auto opportunity. And when Tesla is pricing in more than that, it's time to take a step back and wait. And that's what I'm recommending today. I think buying Tesla below $1,500, sorry, I'm still on the old stock, so below $300 makes a lot of sense. Yeah. Buying Tesla above that level becomes a suboptimal use of capital, okay?
Right, so you're getting a car and a herd of unicorns at the same time. Pierre Ferragu.
Exactly, you get it. That's exactly the point.